Do you really want to know how to become a profitable day trader? Hi, I'm Marv Eisen from Timeless Dollar Trading Academy. Becoming a profitable day trader isn't about gambling, isn't about guessing, or staring at every tick on the screen. It's about learning a repeatable method and mastering discipline and knowing when to trade and when not to trade. Most traders lose money because they jump in before seeing price setups that give clues about where the market is actually headed. Most traders also get impatient to put their money at risk because of FOMO, fear of missing out. In this video, I'll follow up with examples so you'll see what I'm talking about. Trading profits don't come from seat-of-the-pants guesswork, but from clues that the market offers you. Traders can get one of the best clues even before the market opens from the Taylor Trading Zone. The Taylor Trading Zone gives one of the most important clues about where the market might be heading because it predicts the day's likely price range, and the Taylor Trading Zone is pretty accurate. In addition to Taylor's Trading Zone, other clues come from price patterns, stochastics, and recognizing the 6 primary trade setups: gap, support and resistance, trend, time and price, momentum, and candlestick patterns. Now, these concepts, and I've spoken about them many times in my videos, combined with patience and disciplined execution, are the bedrock of becoming a profitable day trader. If you think you can go beyond instinct and emotion and build a structured path toward consistent profitability, these few items are the only things you need to know. You can trade smarter, but not harder, and make fewer trades to boot. Let's start with the Taylor Trading Zone, which is based on George Taylor's calculations, and these are a dozen calculations that come down to an average of averages that give us the trading zone based on the support and the resistance for the trading session. Now, you're looking at the Taylor calculator. It looks very complicated. It's very simple. In the leftmost column, you'll see the dates. And in the 4 columns to the right of that, you see the open, high, low, and closing prices for those dates. With that information, all the data to the right is charted automatically. Now, the only 2 lines that I'm going to point out in this video are the 2 columns in yellow, the resistance and the support numbers. There's also a gray column that is the range between these 2 numbers. Resistance minus support. Very simple. So we take these 2 numbers and we plot them on our chart. Now the rest of the columns, and I told you to disregard it, but just briefly I'll tell you what they are the way that the 2 yellow columns are constructed. And again, the Taylor Trading Zone is based on a calculation of a dozen averages. And so the calculator actually calculates it all automatically. So let's see how this works in actual practice. And I'll put a link to the explanation of each of these columns in the next video. On the particular day that I'm going to illustrate, the resistance is 69.06 and the support is 68.46. And this is for the S&P E-mini. 60 points is the range between the 2 numbers in the yellow columns, 69.06 and 68.46. 60 points. Now let's take this over to our chart. Now here's my chart with those numbers plotted out representing the Taylor Trading Zone or the trading zone. This is the area where prices are likely to trade. Resistance and support. And resistance up here at 69.06, support down at 68.46, and this horizontal line is the previous day's close. And this is how I set up my chart, and these are the clues that I have even before the market opens. And I'm going to start the action. As you see, I have the market just set up, queued up to begin, and what we're looking for are clues to trade. Now, as the day opens, prices seem to begin at the top of the trading zone and head down toward the previous day's close, the gap trade, the classic gap trade. But then prices halt and reverse. Now watch what happens here. I'll stop it right over here. And other than a potential gap trade, what do you see? You see a lot of volatility. If you are really looking, you see a lot of volatility. There are 5 points between, or actually there are 4 points between each horizontal line on this chart. Significant, but you see the volatility between these 3-minute candles. One candle red, one candle green, market going seemingly toward the previous day's close, the gap trade. But let's see what happens. The first clue we can see is this hammer at the bottom of a decline. It's significant because unlike the previous candles, we see a small real body with a very long shadow at the bottom of a decline, indicating a potential reversal. Do we see a trade here? Do you see a trade here? Well, there's always the gap trade. Now watch what happens. I want to point out another clue. Okay, right over here, we see a resistance right up at 68.99. We see a resistance put in by a double top. Hasn't taken out the previous day's high, which was the opening 9:30 candle right over here. And so we have another clue. We have a potential resistance. We have a test of the high, which was put in at the 9:30 open. And we have the trading zone 60-point range. Now, I want to point out that the trading zone is particularly accurate on most days. So we're looking for a 60-point range, but a 60 points from where? 60 points from the highest point of the candle, or 60 points from the lowest point of the candle. The candle I'm talking about is the high or low in the first half hour to hour of the day. And so where is the high? Where is the low? The high is over here at 9:30. The low is over here at about 10:20. So we have a high, we have a low, we have the Taylor trading zone. So at this point, there are 2 possible areas where prices might trade using our transposed trading zone. I'm going to transpose the trading zone, meaning I'm going to make a clone of it, and I'm going to bring it to the intraday high, right over here. Oops, let me move this over here. Right over here is the high. And I'm going to clone it again, and I'm going to move this clone to the intraday low, right over here. Let me shorten up my chart. So there are 2 possibilities. If I believe that the prices are going to track the 60 points that are predicted by the trading zone. Prices are either going to end the day up here, or they're going to end the day down here, all right? So I've moved my trading zone to the potential high or the potential low. I have the resistance put in. Remember, one of the 3 trade setups is support and resistance. So we have a resistance, we have an intraday high, we have the previous day's close, we have the 60-point range from the Taylor trading zone. Let me make these trading zones a little different color so that they'll be a little more distinct. I'm going to make that one this, I'm going to make this one, I think I'll make this one red. So now I'm going to continue the price action, and the prices, my clues, are going to tell me prices are going to hit this line, or there, or just about there, or hit this line. So now I have a pretty good idea of where the prices are going to trade, and so will I trade to the upside or will I trade to the downside? And so as the day goes on, watch where prices go. And at a certain point in time, we can tell very clearly that they're going to go to the downside. And that's where we're going to put our trade. And when we're going to put our trade is when we feel comfortable that that's where prices are going to go. All right? And so here's the day. Here's how the day finished up. Prices went right from the high of the day, the intraday high, to the intraday low. This was the cloned range. Remember, here is the range that I'm using. And when prices went from the high of the day in the first half hour to hour, which was right over here, there was a resistance put in, but the resistance did not take out the day's high. And at a certain point in time, using that 60-point determination, we could take a trade with a pretty good idea that we are going to be correct and make ourselves about 30 points, all right? If we jump in somewhere after the market took out this low right over here at 1020. And so that's how to become a more profitable day trader. Thanks so much for watching. Trade safely, use lots of patience. And as I said, I'll put a link to the video, to a video that explains the calculations of how Taylor's trading zone is formulated. Again, thanks for watching. Trade safely, use lots of patience, and I'll see you in my next video. Marv Eisen from Timeless Dollar Trading Academy.